Welcome back to Stock Daily. It's September 2nd, 2025, 8:35 p.m. Eastern Time, the first trading day of September after the Labor Day long weekend. Coming off the break, the market showed signs of renewed energy, though volatility clearly picked up. All four major indices opened lower today, but managed to claw back losses into the afternoon, ultimately finishing with modest declines. For the S&P 500, intraday weakness tested the 6,360 support level, a line we highlighted previously before buyers stepped in. While that support held, September has only just begun, and history tells us this month often brings heavier selling pressure. What we saw today looks like the early innings of a broader period of volatility. One of the key market drivers today came not from the U.S. itself, but from the global bond market. Treasury yields pushed higher in sympathy with European debt markets. UK government bond yields rose on renewed debt concerns, while French yields spiked sharply on political instability. At the same time, heavy new issuance across Europe added to the pressure. Bloomberg data showed that between the UK and Italy, Europe set a record 49.61 billion euros in single-day bond sales, about 57.7 billion. That flood of supply, coupled with fiscal worries, pushed yields higher across the curve. For long-dated bonds especially, investors are demanding higher risk premiums as sovereign debt levels globally remain a structural problem. Let's first take a look at the U.S. data. August ISM manufacturing PMI rose slightly, from 48.0 to 48.7, still below expectations of 49. The employment index slipped to 43.8, while new orders improved, climbing back into expansion at 51.4. The prices paid index cooled to 63.7, down from 64.8. Historically, ISM manufacturing has tracked closely with GDP, and today's report suggests real GDP growth in August at roughly a 1.8% annualized pace. That's positive but modest, reinforcing the view of a slowing yet still resilient economy. Now turning to company specifics. One headline today was the U.S. Commerce Department's decision to revoke export license waivers for Intel, Samsung, SK Hynix, and TSMC, covering certain shipments to China. For TSMC specifically, the waiver for its Nanjing fab, which produces 16nm chips, will expire on December 31, 2025. While that sounds dramatic, investors should keep perspective. The Nanjing plant contributes only a small fraction of TSMC's total revenue, and the products made there, 16nm and older nodes, are not the company's high-margin growth drivers. TSMC's core revenue and profitability come from advanced process nodes like 5nm, 3nm, and soon 2nm chips that power AI accelerators, smartphones, and high-performance computing. So while geopolitics add headline risk, the fundamental impact looks limited. TSMC is also reportedly considering a price hike of 5 to 10% for its advanced nodes starting in 2026, aiming to offset U.S. tariffs, exchange rate pressures, and supply chain costs. That pricing power is critical for sustaining margins. Of course, for major customers like Apple and Nvidia, higher chip costs could squeeze profitability, but the fact remains that TSMC's technology lead allows it to command a premium. Shares today dipped to $225, with near-term support between $226 to $229 and stronger levels down near $209. Resistance sits around $236 to $237. For long-term investors, the company's growth trajectory remains intact, and even if shares pull back into the low 220s or below, that may represent a healthy entry point. Speaking of mega-cap tech, let's talk about Alphabet. Google shares surged after hours, at one point up more than 7%, before settling at gains around 6%. This rally comes as investors reassess Google's valuation in light of recent legal developments. Last year, a U.S. district court found that Google violated antitrust law by maintaining monopoly power in online search. However, a long-awaited ruling delivered remedies far lighter than feared. The court barred Google from signing exclusive contracts with partners, but stopped short of forcing a breakup of Android or Chrome. The judge also rejected calls to ban Google's payments to partners for default browser status, warning such a move would harm consumers and the broader ecosystem. In short, Google was found guilty of monopoly practices, but the remedies were mild. For investors, this removes a major overhang that had weighed on multiples. Today, Alphabet trades back near the lower end of its historical valuation range, around 26x forward earnings, which is still reasonable compared to peers. Nvidia remains another focal point. Rumors surfaced last week claiming supply shortages for its H100 and H200 AI GPUs, but the company quickly refuted them, stressing that inventory is sufficient to meet demand. Shares fell to $169 intraday before closing just above that level, holding key technical support. If the stock breaks below, the next strong zone sits around 156 to 159, where many long-term investors are prepared to add exposure. Fundamentally, nothing has changed. Nvidia remains the dominant AI hardware supplier, with year-over-year revenue growth still above 40%. With AI adoption spreading into cloud, enterprise, and edge computing, demand remains robust. The only real headwind near-term is valuation and positioning. Many institutions are overweight and using September's seasonal weakness to rebalance. For investors, that creates tactical buying opportunities, though patience is key. On Tesla, the technical picture shows shares consolidating between $314 and $37. A breakdown below $34 would mark a more serious structural shift, but for now, the stock remains in a neutral consolidation. Despite ongoing margin pressures in EVs globally, Tesla continues to benefit from software upgrades, energy storage growth, and its leadership in autonomous driving. Still, competition from Chinese EV makers like BYD remains a key risk, especially as price wars continue in Europe and Asia. Advanced Micro Devices, AMD, also drew attention today, holding in the $153–$160 range. With Nvidia commanding headlines, AMD remains a second-tier beneficiary of AI investment, particularly through its MI300 accelerator chips. Demand hasn't matched Nvidia's yet, but AMD is gaining traction with hyperscalers, and its valuation looks more attractive relative to Nvidia's. Lastly, let's touch on the broader market via the Nasdaq 100 ETF, QQQ. It briefly fell below $560 today, before bouncing back to close around $565. If it decisively breaks 560s, downside targets include $527, $505, and potentially $468.86. These levels represent attractive entry zones for investors seeking to add exposure to large-cap tech. Importantly, the S&P 500 and Nasdaq both defended critical supports today, suggesting institutions are still buying dips. September often brings volatility due to fund rebalancing, but the fundamental backdrop, resilient GDP, solid earnings, and no imminent recession, doesn't support the case for a lasting bear market. Pullbacks should still be viewed as opportunities. Stepping back, seasonality tells us September is historically the weakest month of the year for equities. But corrections during bull markets often set the stage for the next leg higher. As long as earnings and growth hold up and inflation continues trending lower, equities should remain supported into year-end. For investors, the key is to maintain discipline. Know your entry levels, manage risk, and don't chase at stretched valuations. Long-term opportunities in AI, cloud, semiconductors, and selective consumer names remain compelling. That's the update for today, the first trading day of September. As always, stay focused, stay patient, and remember that volatility often creates opportunity.